This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This is a lecture on transfer pricing for paper F5, and it's chapter 17 of the course notes, page 93. Now, first of all, let me explain what we mean by transfer pricing, what a transfer price is. And what it is, it's a situation where we're divisionalized, and we covered divisionalization in the previous chapter, but we've got one division that perhaps supplies goods to another division. You know, perhaps have a factory in one city which makes goods. They send them to another division which sells the goods. Well, a transfer price is when we allow one division to charge the other division. So that's all it is. A transfer price it's the price charged by one division for goods or services supplied to another division. So before I say any more about why or what the problems are, look at example 1, a very simple one, where it says Division A produces goods, they transfer them to Division B, which packs and sells them to outside customers. So let me draw a little picture. It's a very obvious one, this, but because of one or two things that can happen in later examples, I always think it's a nice idea to draw a picture. So we've got Division A. They're producing goods, and it says in the next line, the costs are $10 a unit. They're sending those goods to Division B. It says Division B packs them. And again, on the second line, Division B, they've extra costs. So the costs of packing are $4 a unit. They then sell them to outside customers. And it says below, Division B sells the goods to external customers at a price of $20 a unit. Part A of the question says, what's the total profit made by the company? Now, there's only one company. Do appreciate, this isn't two little companies. There's one company with two divisions. And as far as the company as a whole is concerned, the selling price per unit is 20. The costs in the company, in Division A, there's 10. In Division B, there's another 4. And so the company as a whole is making a profit of $6 per unit. However, it says below the requirements there's a transfer price between the divisions of $12. So it means we're allowing A to sell to B at $12 a unit. And part B says, what's the profit per unit made by each division? So if we do a little profit statement for each division, Division A now is treated as selling them to B at $12. So they've got sales, or the transfer price, $12 per unit. The costs in Division A are 10. So Division A reports a profit of $2. Similarly, Division B. Well, Division B sells to outside customers. The selling price is 20. Their costs, though, they're now having to pay Division A the transfer price of $12. They've got their own costs of another 4 to pack. And so Division B, they're reporting a profit of $4. And so, of course, the total profit, whatever happens, the total must be $6. We already knew that. All the transfer price has done has been to split the profit between the two divisions. And so the next question over the page is, why bother? You know, I keep saying there is only one company. The profit is $6 a unit. Why bother letting A charge B? And the reason is so that we can make each division profit accountable. If I want to measure the performance of each division, if I want to measure the profitability, then without a transfer price, then of course A has all the costs and no revenue. B has all the revenue and very little costs. Well, letting A charge B, we are able to do a profit statement for each division and measure, compare year by year or whatever, but measure the profitability of each division separately. The next question, though, is how are we going to decide on a transfer price? In the previous question, it said it was $12, so we just did what we were told. But how are we going to decide on the price? And a very common method in real life is something called cost-plus transfer pricing. And all cost-plus is where we have a policy of saying whenever there are transfers between divisions, that the price charged will always be cost plus a fixed percentage. Let me show you what I mean with example 2. Division A has costs of 15, they transfer to B, which has extra. So let's draw a picture again. Division A transfers to Division B. Division B sells outside. A has costs of $15 a unit. B has extra costs of $5. And this sell externally at 30. Well, I'm going to do the question in a slightly different order. First of all, I'll do part B. For the company as a whole, what profit do we make? And as I've kept saying, there is only one company. And so the company, overall, the selling price is 30. There are costs in A of 15 and in B of another 5. The company is making a profit of $10 a unit. However, we want to make each division profit accountable, and so we're going to have a transfer price. And simply following instructions, it says, the last line of the question, the company has a policy of setting transfer prices at cost plus 20%. Well, no problem. It's A doing the transferring. And so they'll transfer at a price which is the cost of 15 plus 20% of 15. They'll transfer at $18 a unit. So now let's see how much profit the divisions make individually. Division A, they're selling at the transfer price of 18. The costs of 15, and so the profit is 3. Division B, they sell outside at a selling price of 30. Their costs, they have to buy from A at 18. They've got their own costs of packing or whatever it is of another 5. A profit of 7. So again, the total is $10. It must be $10. All the transfer price has done has split that profit between the divisions. However, although a cost-plus approach is in fact very common because it's a very easy policy to operate, especially a company which has lots of divisions and lots of goods being transferred, there are 2 big problems. The first is this, that why are we doing this? Why are we making the divisions profit accountable? It's to try and get each division to perform better. We want each division to make more profit. But there is one huge problem here, that how can Division A make more profit? Division A's sales are their transfers to B, and they're told they have to transfer at cost plus 20%. That's the policy. So how could they possibly make more profit? The only way they can make more profit is to increase the costs. If they increase the costs, if they increase the cost to 20 a unit, for example, add on 20%, $4, they'll make more profit. But that, of course, is stupid. We want to encourage Division A to cut costs. That's what's good for the company. But if A cuts costs, they add on 20%. They'll be making less profit, which is daft. And so the first problem is there is no motivation for A to cut costs. In fact, as I've said, it's quite the reverse. A is actually motivated to increase costs. The second problem, though, is a bit less obvious, and is what I'm about to illustrate in the next example. But this approach, it can lead to decisions that are bad for the company. And to explain what I mean by that, look straight at example 3. And can you have a go? It's very, very similar with different numbers. A has costs of 20, the transfer to B, which has costs of 8, they sell at 30. Transfer price is set at cost plus 20%. Can you have a go yourself? It shouldn't take you many seconds. But have a go. How much profit does the company make? What's the transfer price? And how does it split between the divisions? Pause the recording, and when you've had a go, start it again. Well, let's have a look. Again, I will draw a picture. A has costs of 20. They transfer the goods to B, which has its own costs of 8. B sells outside for 30. Well, again, if I do the requirements in a slightly different order, B, as far as the company is concerned, selling price 30. The company has costs in the first division of 20 and the second of 8. This product generates a profit of $2 a unit for the company. The transfer price, our policy again is cost plus 20%. So A is doing the transferring. The cost is $20, add on 20%. $24 a unit. Finally, the divisional profit. A, they're transferring at 24. They have costs of 20, a profit of $4. B, selling price 30. The costs they're buying from A at a cost of 24. They've got their own costs of 8. They make a loss of $2. And of course, in total, there's a profit of $2, which we already know is the company profit. The company makes $2. All the transfer price does is split it. However, there is one huge problem here. We've given the managers autonomy, the authority to make their own decisions. And the problem is, Manager B, if they deal in this product, they're going to make a loss. And so Manager B surely is going to refuse to deal in the product. It won't mean B closes down. We always assume there are lots of other products. But this one individual product, surely if it's loss-making, B will refuse to deal in it. And of course, if B won't buy it, A has no one to sell it to. And so the problem is B refuses the product. And therefore, the company loses this product. But of course, we know that the product is good for the company. Overall, the company makes a profit of $2. The company wants the product. But the danger is, if we allow a transfer price that results in either manager making a loss, the managers will decide not to do it, and the company will lose it. Here, it was B that decided not to because the transfer price was so high. But equally, if the transfer price had been less than 20, if you'd had a transfer price of 18, A would have made a loss. And of course, A would then have refused. And that's the big problem. And that's what leads to any arithmetic you're likely to get in the exam. That we've got to make sure that however the transfer price is set, we've got to make sure that it's sensible, in that it does end up with the managers making decisions that are good for the company. And so that's where the real work is, being given a situation and being asked to suggest a sensible transfer price. Look with me at example 4. Example 4, in fact, is exactly the same as the one we've just done, in that A has costs of 20. They're selling to B, which has its own costs of 8, and B is selling outside at a selling price of 30. And this time it says, suggest a sensible range for a transfer price. And the way to approach it is this. First of all, pretend you're manager of Division A. You're prepared to sell this to B, but what does the transfer price have to be for you to be prepared to sell it? And surely if you've got costs of 20, you're more than happy to sell to B, provided the transfer price is at least 20. And always, as you'll see when we look at more examples, manager A fixes the minimum transfer price. The transfer price has to be at least, strictly, it's greater than or equal to, but I'm not really worried there. But it has to be at least 20 for A to be prepared to sell. Then put yourself in the position of manager B. If you're manager B, what's the most you're prepared to pay to buy this product from A? Well, you're going to sell it for 30. You're going to have to pay costs yourself of 8 anyway, which leaves you with a net 22. And therefore, surely, the most you're prepared to pay is 22. At the 30, you're going to get less your own costs of 8. If you're going to be profitable, the transfer price has to be less than 22. Manager B fixes the maximum. And therefore, the transfer price must be in the range 20 to 22. Anything within that range, I'm happy. Let the managers argue. But provided the transfer price is somewhere within that range, A's motivated to sell, B's motivated to buy, and we already know that would be good for the company. But we cannot allow the transfer price to be less than 20 or more than 22. Now, before we carry on and say a little more, two things. First of all, the reason the transfer price had to be at least 20, it was to cover the costs. We have to sell it for more than cost, I think clearly. However, we always assume that A already has other products and is happily making a profit. And therefore, all we're concerned about for this product is that we cover any extra costs. So we assume any fixed costs won't change, that the only extra costs will be the extra variable or marginal costs. Marginal, remember from earlier chapters, means variable. But the minimum transfer price, it has to be at least the marginal cost. The 22, well, I hope you saw how we got the figure 30 minus 8. We call that the net marginal revenue. Now we're going to carry on and look at a few more little examples, and I will give you a rule ultimately, but this is one area where I think just to learn a rule is dreadful. If you understand what's happening, you can actually deal with any situation. You don't really need a rule. So I'm not prepared just to state a rule immediately. We're going to look through three little examples, and as you'll see, we'll effectively build up the rule ourselves. So can you turn the page? And let's look at example 5. Division A has costs of 15, they transfer to B. So, forgive me, I'm going to draw a picture again. A has costs of 15, they transfer to B, which has additional costs of 10, and B sells outside for 35. However, there's a bit extra here. It says A can sell part finish units externally for 20. So see, what's happening is perhaps A is making desks, but they're not painted. Perhaps B paints them and then sells them. However, as an alternative, A can sell the unpainted desks, the part finish desks. They can sell them outside. And of course, because they're not finished, they sell them at a lower price. It says they can sell them externally for 20. And note the last line. And this isn't me playing games with words, it's exam wording. It says there is limited demand externally from A, and A has unlimited production capacity. So A can produce as many as we possibly want. They can sell outside, but there's a limit to how many they can sell. Perhaps they can only sell 1,000 outside, I don't know. There's a limit to what we can sell, but we can produce as many as we want. Well, of course, by all means, sell outside. Costs 15 and we sell for 20. We make a profit. Great. But B wants this product. And so our job is to determine a sensible range for the transfer price. Well, take the attitudes I did before. Pretend you're manager A first of all. Manager A fixes the minimum. What's the minimum price at which you're prepared to sell to the other division? Well, I hope you came up with an answer, and see if you got the right answer. The minimum price, the transfer price, must be at least 15. Now, some people say 20, but see, why not? You see, we cannot sell outside and get 20 at a cost of 15. And so fine, do. Sell outside and make a profit of $5 a unit, but there's a limit to how many you can sell. If outside customers want 1,000, sell them 1,000. But B wants them as well, and we've unlimited capacity. So surely sell whatever we can outside, and in addition, make some more units and sell to B. Obviously, you want to charge B as much as you can, but anything more than 15 is worth having. You'll still get your profit outside, but in addition, sell to B as long as you get more than 15. What about B? Well, manager B fixes the maximum. And the maximum they'll pay, well, similar logic to before, it'll be the net marginal revenue, 35, their own costs of 10. The most they'll pay is 35, and provided, 25 rather, provided the transfer price is within that range. A will sell to B, B will buy from A, and that is automatically good for the company. Okay, let's move on to number 6. Division A has costs of 15. They sell to division, or they transfer to division B, which has costs of 10, and B sells outside for 35. Again, A can sell part finished units externally for 20. This time, though, there is unlimited external demand from A, and A has limited capacity. Now read that carefully and see the difference in wording. It means that everything A can produce, all of it, could be sold outside for $20. But again, B wants this product from A, and we can supply it to B quite happily. But because at the moment we're capable of selling everything outside, surely every unit we supply to B means there's one less unit that can be sold outside. We want a sensible range. Again, firstly, if you're manager A, what's the minimum price at which you're prepared to sell to B? This time, the minimum price is $20. And the reason is this, and if you've just written down 20, fine, you'd get full marks, but do see why. The point is that whatever happens, you won't sell to anybody for less than 15, the marginal cost. However, this time if you sell to B, every unit you sell to B, you're losing a sale outside. And if you sell the unit outside, you sell for 20, costs 15, you're making a contribution of $5 a unit. So you're only prepared to sell to B, provided you're getting at least the same contribution. We need to cover the lost contribution of $5. Therefore, we must get at least 20. Now, I've already said if you've just written down 20, that's fine. But do see what I've written here, because I'll show you later, it just could be a little bit less obvious. You could need to write it down the way I've done. What about manager B? Well, of course, it's exactly the same as before. And so the maximum B would pay. The net marginal revenue, 35 less 10, 25. The transfer price would have to be in the range 20 to 25. Is that good for the company? You see, if the transfer price is 20 to 25, B will buy. A will prefer to sell to B. If they get more than 20, they prefer to sell to B. Is that what the company wants? Of course it is, because the company has the choice. If A goes to B and then outside, they're making what? 25, 35, $10 profit? If on the other hand, A is allowed to sell outside, they're only making $5 profit. The company's better off if A does sell to B, and provided the transfer price is in that range, A will prefer to sell to B than to sell outside. All right, just one more, then I'll give you the rule. Look at number 7. Division A has costs of $8. They transfer to B, which has extra costs of $4. And B sells outside for $20. Determine a sensible range for the transfer price if Division B can buy part finished goods. So this time Division B can buy goods elsewhere. 4. Now appreciate it's 2 separate questions here. First of all, for 14, we'll look at B after. Okay, manager A. A always fixes the minimum price. And what's the minimum they're prepared to charge? Well, $8. It must be more than cost. What about B? Well, we already know that B wouldn't pay more than net marginal revenue. The net marginal revenue is 20 minus 4, 16. They wouldn't pay anybody more than 16, otherwise they'd make a loss. However, they can buy outside for 14. Well, of course, why on earth should they buy from A unless it's less than 14? The transfer price must be less than 14, the price at which they can buy outside. The range 8 to 14. On the other hand, look at part B. Part B, we had exactly the same problem, but the outside purchase price was 18. Well, of course, the minimum transfer price is fixed by A and it would still be 8. But what's the most that B would pay? We've already said they'll never pay anybody more than 16. So in fact, they wouldn't buy outside. They're not going to pay 18. They'd generate a loss. And so they'll buy from A, provided A charges less than 16. Now, I hope those 3 made sense. If they didn't, look back and listen to them again slowly. But having done those 3, I can now write down the rule which will apply to anything. I said earlier, I think here it's much more important to see the logic. If you see the logic, then it's reading carefully. It's not rules. However, if you want a rule, here it is. I've left space on page 97. First of all, the minimum transfer price it's always fixed by the transferring division. In my examples throughout, it was division A. And it's always the marginal cost plus any lost contribution. And the word you're looking for, the time when there's likely to be a lost contribution, is where there is limited capacity. If you look back at example 6, in example 6, we had limited production capacity. It all could be sold outside, and therefore selling any to the other division would mean we were going to lose contribution. That's the rule for the minimum. The maximum transfer price It's fixed by the receiving division. In my example, it was division B. And it's always the lower of two things. It's the lower of, firstly, the net marginal revenue, as I hope I've explained, they'll never pay more than net marginal revenue, otherwise they'd be loss-making. It's the lower of that and any external purchase price. Well, that really is it. That's the rule that would deal with anything. However, just to give you a little puzzle, can you have a look at example 8? If anything, it's perhaps slightly more than you'd asked, particularly since transfer pricing isn't that common in F5. But I'd rather do slightly too much than too little. Have a look at example 8 yourself. See if you can sort out what's happening, and more importantly, a transfer price. All right, well, I assumed you paused and had a go yourself. Let me do it now and see whether you got it right or not. A is capable of making two products, X and Y. And both products can be sold externally. So A can make X or Y. Product X, the costs are 60, and we sell it for 80. Product Y, the costs are 70, and we sell for 100. Further down, though, division B requires product Y. Now, I've not given you any details about division B, and the question says all it requires is the minimum transfer price. So what's the minimum A would charge to supply Y to the other division? And, of course, the important bit, it says A has limited labour available. There's unlimited demand for both products X and Y, unlimited external demand. So we've got capacity limits. Everything A produces could be sold outside. And so if we produce anything for the other division, immediately we're taking up some of these limited hours, we'll lose outside sales, we'll lose contribution. So we have to work out how much we'd lose. Now, so let's first of all ignore the other division. Without the other division, what would we do? Well, we have two products, remember, X and Y, and both of them there's unlimited demand. So what would we produce? Something you should have seen before at paper F2, and in fact, in an earlier chapter in these notes. See if you remember as we go through it, that X and Y, the contribution per unit product X gives a contribution of $20, product Y gives 30, and so of course Y is more profitable, except it's labour that's limited and the hours needed per unit. If we produce unit X, we need 5 hours. Unit Y, we need 10 hours. So I hope it's clear to all of you that with limited hours, if you'd only 10 hours, with 10 hours you could make 1 Y or 2 X's. X would be better. Or standardly, don't we look at the contribution we'll generate per hour. Each unit of X gives $20 but takes 5 hours, so each hour spent making X generates $4. Whereas product Y, $30 from 10 hours, $3. And so with limited hours, surely we'd use all our hours producing X, and we generate $4 for every hour. However, there is the other division. The other division wants Y. Well, obviously we can produce Y. No problem. But the trouble is, every unit of Y we make is stealing some labour. Labour that we would have been using to make X. And so, how much do we need to charge? Well, whatever happens, we need to cover cost. The marginal cost of Y, check the question, is 70. We have to charge more than cost. But because of the limited capacity, we are losing contribution. And how much are we losing? We're losing $4 for every hour we take. And how many hours does Y take? It takes 10 hours. We're taking away 10 hours for each unit. Hours that could have been earning $4 by making product X. And therefore, we'll have to charge at least 110. And sorry, the transfer price must be greater than or equal to. But we are prepared to sell Y to the other division, provided they pay at least 110. If they won't, we're better off selling X outside. And if you're at all unsure, just look. If the other division does pay 110, the costs are 70, the contribution would be 40. It takes 10 hours to make. We'd be earning $4 an hour. Well, of course, if we were earning $4 an hour from Y, I'd be quite happy. I don't care if I make X or Y. But if Y is giving less than $4 an hour, if Y is sold for less than 110, then we prefer to make X. However, the transfer price must be at least 110.